Hey guys, thanks for jumping back into the cryptoverse. If you guys like this content, please subscribe to the channel, turn your notifications on, and like the video. And if you guys want to support this content, just check out the description below, and there's plenty of ways you can support the channel. So what we're going to talk about today is Bitcoin, and we're going to talk about risk associated with when you buy Bitcoin. Now, clearly, there's risk associated just with getting into the cryptocurrency asset class. That's obvious. The second layer of risk is when you buy crypto. So once you accept the first layer of it could all go to zero, then the second layer of risk is when do you buy it? Do you buy it, based on the month of the year? Do you buy it when you get a little bit extra on your paycheck? When do you buy Bitcoin? So one of the things I've done here is I've made a plot that shows on a log scale the price of Bitcoin historically. And it's color-coded with a associated risk with buying at that time. And the risk is some complicated equation I made that's a function of several different variables. And essentially what it does is it ultimately gives you a normalized range between 0 and 1. And the point is when the risk is 0 or close to 0, then that's the best time to get into the market. When it's red, when you're getting close to 1, then you definitely want to be selling. Now, obviously, no one can really predict the bottom or predict the top exactly. So what you can do is you can dollar cost average your way into Bitcoin when the risk associated is say between 0 and 0.3, and then you can dollar cost average your way out when it's 0.4 and up. Pretty straightforward if you do it that way. The hard part is staying disciplined and sticking to your principles when you might be feeling euphoric because you're watching your portfolio go up 2 or 3x in a given day. Now, what we're going to do is we're going to, first we're just going to look at this chart. You can see clearly that the dark blue regions, based on this formula, are clear-cut, best times to buy Bitcoin. And the light blue regions, once you get into a risk, say 0.4, it's not always a bad time. It just means that it could be your risk associated with buying at that point is significantly higher. So if you just buy Bitcoin when this is dark blue, you're basically going to be in profit. At least historically you would be. If you buy when it's light blue, then it's hard to say because you can see it's light blue and then it went down. Here it was light blue and then it went up. Light blue and then down, light blue and then up. So typically, what I like to talk about in terms of dollar cost averaging your way in and dollar cost averaging your way out is, this is a long-term investment. Buying in these regions it's a long-term investment into Bitcoin because you believe where it's headed, you believe in the store value, etc. Buying when the risk is say 0.4 and up is more of a speculative short-term thing. You're hoping that the momentum of the market can just carry it up a bit higher so that you can cash out. But a lot of times, buying in these regions, it doesn't always work out. Buying up here at say a risk of 0.5, 0.6. People live through this. A lot of people live through this. A lot of people live through this phase here too. And it's not always pretty, obviously, if you don't know what you're doing. So the key thing to remember is dollar cost average your way in, dollar cost average your way out. Now, if we look at this numerically, so we're taking the color out of it and we're just plotting the color-coded dimension on the secondary y-axis, you can see that, during these run-ups, during these bull markets, the risk starts skyrocketing, and you can see that it starts going up before we get to the peak. So if you have a plan ahead of time and you're going to sell at a certain risk level, then be disciplined about it, take your profits. If Bitcoin goes down, you can be happy that you cashed in. If Bitcoin goes up, you're also happy because you can continue selling more and more, a different percentage or a different part of your portfolio. You could sell 20% at a risk of 0.4, 20% at a risk of 0.5, etc., all the way up. And then you can continue selling it all the way down as well. But the key thing to remember is that you will never predict the top and you will never predict the bottom. And if you can convince yourself to be okay with that and realize that it's not going to happen, then it makes things so much easier. If you sell Bitcoin at 10,000 and then it goes to 15,000, you don't worry about it. You maybe sell more. It's one of those things that we just don't know for sure. So one of the things you can note though is that on this graph you can see there's pretty much a clear-cut bottom in terms of how I define the risk. So if we highlight that, if you dollar cost average the most during a when it's between say 0 and 0.2, you're going to be getting more Bitcoin for your dollar than doing it at higher risk levels, because you can see each of these levels correspond to the lows in the bear market, all of them. So, and this is just historical data. I'm not projecting out. I'm just saying this is what the case has been up until this point. And if you were to sell, how do you know when to sell? Do you want to sell at 0.3? I would argue that buying Bitcoin between 0 and 0.3 risk is completely fine. 0 being the low end. So if the risk is 0, it's the best time to buy, and if the risk is 1, it's the worst time to buy. So as you're down here, you want to buy. As you move up here, you want to sell. So I would argue that for me, what I do is I buy most of my Bitcoin between risk factors of 0 to 0.3, and then between 0.3 and 0.4, I still buy it, but sometimes I sell it too. It's more of a gray area. And then anything above 0.4, I'm typically not buying Bitcoin at that point. I'm typically sitting on it and seeing where it goes. So let's say you're dollar cost averaging your way in, and you're buying over here when Bitcoin is 7,000, and you're buying when it was 6,000, and then it drops. Historically, if you then upped what you were doing, that would prove to be a better method than just doing the same amount every month, no matter what risk associated with the market there is. And some of you guys are probably like, well, you've given this very random formula that you haven't even explained, and at the end of the video I'll show you guys something that it's actually pretty similar to what it's not that similar, but it more or less gives you the same result, just with a little bit less resolution, but it'll get the job done. So I'll show you that at the end of the video. So here, if you're dollar cost averaging your way in over here and up to 0.3, historically you're doing quite well. And then this is where things get hard, okay? And everyone's experienced it. Dollar cost averaging your way out is a lot harder. It's a lot easier to hold in a bear market than it is to sell in a bull market. And the reason is because in a bear market, you'll get frustrated, you'll stop looking at it for a few months, you just don't even want to think about it. But in a bull market, you're pulling it up every 5 seconds, and you don't want to sell because you just get greedy and you think, well, if I sell now and then it goes up another 2x, think about all that I'm missing out on. But that's the wrong mentality to have. You will not predict the top, you will not predict the bottom. Convince yourself of that now before things pick up in the coming years. So, where are we now? So currently, if you were buying in early 2019, you were buying at these risk levels between 0.1 and 0.3, which historically has been a really good time to buy. And if you started selling at a 0.4 and higher, you actually would have come out ahead, because you can see that Bitcoin recently, it's down 50%. Now, you might ask, well, how much do you sell at these points? You don't know where the top is. What I like to argue is that you can sell 20% of your portfolio at each of these levels. And there's two ways to think about that. Do you sell, let's say your portfolio is worth $1,000 and you sell 20%. So, do you sell, you say you sell $200, and then the next 20%, do you sell another $200, or do you sell 20% of $800? And that's up to your own personal preference. If you can continue to adjust the total, then it'll keep more of your money in the market. Or if you just want to say, this is my total investment going in, I'm just going to take out 20% until I'm cashed out. You can do that as well. So what I do, and feel free obviously to do what you want to do, what I do is I just take out 20% at each band. So between 0.4 and 0.5, I take out 20%. Between 0.5 and 0.6, I take out 20%. Obviously, picking at what point exactly you take it out is up to you. But more or less, I take it out at some point in here. And then taking it out between a risk of 0.6 to 0.7, another 20%. And then between 0.7 and 0.8, another 20%. So, if you're just going by the total, that's obviously only 80%. That leaves you 20%. And then in case Bitcoin keeps going up, if it does see some higher high, then you're still holding on to a little bit of Bitcoin. It's not like you've completely cashed out your entire position. And if you see a reversal and we start going down, then you can sell that final 20% and then wait for the bear cycle, the bear market, to run its course. So you can see recently that we popped up into this band. Some of you guys sold, I know. Some of you didn't. And we've recently popped down below it. Now, one of the things that's nice about this is that it's not just a function of the price. So the way I define the risk, the price doesn't have to go down for the risk to go down. So that's something interesting. And we'll continue to follow this, obviously, in the coming months, in the coming years, to see where we are. I can tell you, for me, if the risk, gets lower than 0.3, then I will start dollar cost averaging more than I am now. I will. I'm not saying you should. So, moving forward, where does this leave you guys? Because how do you know what this risk is? So if we go back to the graph I have it as some complicated function. There's another way you can define the risk, and it's actually fairly straightforward, and it gives you more or less the same result. It's just not as resolute. All it is you can take the 50-day moving average and divide it by the 50-week. And the reason this works is because you're looking at short term and dividing it by long term. So the higher this short term goes up, then your risk is going to go up. And I'll just toggle between the two so you can see how similar they are. The reason why I prefer mine is just because it becomes a little more clear where these regions are, whereas just doing it this way, it's not quite as clear. You could experiment with other moving averages as well. It's fairly straightforward to implement. If you just take a short-term moving average and divide it by a longer-term moving average, you can start defining your own levels of risk. Note that the reason it's between 0 and 1 is because I normalized it to be between 0 and 1. If you just take this divided by this, it will not always fall, obviously, between 0 and 1. But even with this, you can see that these very dark blue regions still correspond to the bottoms of the bear market, and the orange and red are the peaks of the bull market. So you can think of it in the same way of dollar cost averaging your way in when the risk is lower. And I'll just remind you, this is what my graph looks like with my equation. And if you use this other, more simple equation, where you just take a moving average and divide it by a different moving average, a longer moving average, this is what you get. So I'll toggle between them so you can see how similar they are. Okay, so it's really not that complicated. If you just want to get something that looks like this, and then you can look at how you manage your own risk. Anytime we're in the green region, you could be dollar cost averaging more than you otherwise would. When you get between 0.2 and 0.3, you can still dollar cost average, but maybe a little bit less, so that your average buy-in is lower on Bitcoin. And then when you get into these bands up here between 0.5 and or 0.4 to zero point 0.5, and then so on and so forth, you just dollar cost average your way out. I know it sounds simple, and in principle it is simple, but because we're human and we have emotions, they can get the better of you. So commit now. I would say this: commit now to figuring out what you're going to do if and when Bitcoin goes on another bull run. Are you going to sit on your hands and watch it go up just to watch it come crashing down? Or are you going to start dollar cost averaging your way out and using that money to better whatever living situation, or provide more for your family, whatever it might be? Or are you just going to watch it go up and then have to tell everyone that you didn't cash out anything and you just watched it crash back down and you've lost money after seeing it go up 10x or more? So consider what you're going to do now, because now is the time to plan, now is the time to build, now is the time that the market really evolves, and the dumb money is going to be here before you know it. I mean, I can almost promise you that. It's coming. It might be a year or two, but it is most likely coming. And when it does come, you need to be ready. And obviously, if your standpoint is, I'm invested in whatever coin because of the technology or whatever it is, you can still sell it and then buy more of it when it goes down. Because anytime you see risks that get, even just taking the simple ratio between a shorter term and a longer term moving average, it always comes down. Okay, whenever the risk gets above a certain level, it always comes back down. So you want to start selling. Okay, it's good to start selling. Take your profits while you can. So that more or less sums it up for this video. I hope this was useful to you. Remember to subscribe to the channel and turn your notifications on. And again, if you guys like this content, please support the channel, and you can find that in the description below. That is it for this time. Until next time, guys. Bye.